Hello and welcome back to the channel, where we uncover the fascinating dynamics behind hard-to-borrow stocks and potential short squeeze setups. Today, we're diving deep into a specific microcap name that's caught our attention with an eye-popping cost-to-borrow fee, ZCMD, or Inc. We're talking about a stock that currently costs over 900% annualized to short, and we're going to break down exactly what that means and why it matters. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Let's start by understanding Inc., ticker ZCMD. Shows ZCMD logo/company infographic. This company operates in the healthcare and health information services sector, primarily in the People's Republic of China. Under their endemic brand, ZCMD provides healthcare information, education, and training services to healthcare professionals. They also dabble in patient management services and even the sales of patented drugs, operating through two segments: endemic services and sales of patented drugs. With a tiny market cap of just $1.09 million, ZCMD is very much a microcap stock, which often means increased volatility and unique trading dynamics. What is cost to borrow and why it matters? So, what exactly is cost to borrow and why are we focusing on ZCMD's astronomical rate? When you short a stock, you're essentially borrowing shares from a broker, selling them, and hoping to buy them back later at a low price to profit from the difference. But borrowing isn't free. You pay a fee known as the cost to borrow, or CTB. This is like paying rent on those borrowed shares. The CTB rate is usually expressed as an annualized percentage. When a stock is hard to borrow, it means there's very little supply of shares available for shorting, or very high demand from short sellers, or both. The scarcity drives up the borrowing fee. For ZCMD, the fee is currently a staggering 927.8% annualized. Think about it, if you hold a short position for a full year, it would cost you almost 10 times the value of the shares just in borrowing fees. Why this stock is hard to borrow right now. Now let's look at why ZCMD is lighting up our hard to borrow screener. Show screener data graphic. The annualized cost to borrow fee sits at an incredible 927.8%. While that number is already extremely high, we've seen the CTB momentum decrease by 27 percentage points over the last 5 trading days, suggesting some slight pressure easing or perhaps a temporary dip in demand. Crucially, there are only about 2,000 shares currently available to borrow. That is an incredibly tiny number for a company with an estimated float of 1.1 million shares. This extremely low borrowable supply combined with a high fee gives ZCMD a composite squeeze score of 49.8 on our internal 0-100 scale, which factors in CTB level, momentum, shrinking supply, float size, and technicals. Squeeze mechanics explained. This brings us to short squeeze mechanics. When a stock is hard to borrow and the CTB rate is extremely high, short sellers are under immense pressure. If the stock price starts to rise, two things happen: their unrealized losses increase, and their daily borrowing costs eat into any potential future profits. If the stock continues to climb, some short sellers may be forced to cover their positions, meaning they have to buy back the shares they borrowed to return them. This buying activity, known as a short squeeze, can create a cascading effect. More buying pushes the price higher, which forces more shorts to cover, further accelerating the price. It's a powerful feedback loop, especially when the float is small, like ZCMD's 1.1 million shares, and the borrowable supply is almost non-existent. However, it's vital to remember that a high cost to borrow doesn't guarantee a squeeze. It can also mean short sellers have very strong conviction that the stock price will eventually fall further, and they are willing to pay a premium to maintain their short positions. Dilution risk check. One of the biggest silent killers of a short squeeze is dilution. This happens when a company issues new shares, increasing the total share count and often pushing the stock price down. This extra supply can flood the market, negating any buying pressure from short covers. Journal dilution risk graphic for ZCMD. Our check for recent dilutive SEC filings, things like S-1, S-3, or 424B forms in the last 90 days, found no such documents. This is a positive sign for any potential squeeze thesis, as it suggests the company isn't currently planning to flood the market with new shares that could offset the scarcity. Recent reverse split watch. Now for another critical piece of context for ZCMD. The company executed a reverse stock split, a 1-4-3 split, just 16 days ago, on June 29, 2026. A reverse split reduces the total number of outstanding shares and proportionally increases the share price. For example, if you had 3 shares at $1 each, after a 1-4-3 reverse split, you'd have 1 share at $3. This reduces the float, which can sometimes amplify volatility for a squeeze, and resets the share price higher, potentially making it more attractive to certain investors or meeting exchange listing requirements. Historically, many microcap stocks, particularly those that have conducted reverse splits, tend to see new volatility or a price pop within approximately a month after the split. This is a pattern observed in some names, not a guarantee for ZCMD, but it's an important factor to watch as we are currently well within that typical timeframe. Before we go any further, let me reiterate this important disclaimer. Important disclaimer: this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Let's look at ZCMD's recent price and volume action. Show price and volume chart today. ZCMD is down 4.7%. Over the last 5 days, it's dropped 18.32%, and looking at the last 30 days, the stock has plummeted by 67.74%. This significant downturn is likely what's attracting short sellers, despite the incredibly high borrowing fees. Today's volume is also very low at just 186,400 shares, which is only 0.1 times its 30-day average volume of 3,610,574 shares. Low volume can mean that any significant buying pressure, whether from short covering or new buyers, could have an outsized impact on the price due to lack of liquidity. What we'd look for in a squeeze scenario is a sustained increase in buying volume, especially on green candles, accompanied by continued low borrowable shares and a potentially rising CTB fee. The combination of its microcap status, tiny borrowable float, and recent reverse split makes ZCMD a truly unique stock to monitor for extreme volatility. ZCMD, with its 927.8% cost to borrow, just 2,000 shares available to short, and recent reverse split, presents a compelling case study in the dynamics of hard-to-borrow microcap stocks. While the high borrowing costs indicate intense short interest or extreme scarcity, the steep price declines suggest short sellers have been in control. The question is, can that continue given the incredible cost of maintaining a short position? Keep a close eye on borrow availability, volume surges, and price action for ZCMD. If you found this deep dive into Joncha Inc. informative, please hit that like button, subscribe for more unique stock breakdowns, and let us know in the comments what other stocks you want us to analyze. Thanks for watching and happy trading.